Good morning, good afternoon, good evening to everyone joining us from around the world. My name is Dan Casera. I'm responsible for the financial inclusion research portfolios at the Center for Effective Global Action, or CEGA. We're a research hub based at the University of California, Berkeley, aiming to generate evidence that can be used to improve people's lives. I'm excited today to be joined by Seth Garz, a senior program officer at the Bill and Melinda Gates Foundation's Financial Services for the Poor team. And we're going to be presenting a forthcoming report exploring the rise and impact of digitizing credit. And I also want to give a big thank you to our teammate, Ariana Zapanta, who unfortunately could not be here today, but without whom this report would not be possible. So before we jump all the way in, let's just take a step back and think about why we need a report like this. I don't think for this audience it'll be controversial to say that digital credit is something that is growing very rapidly in terms of the number of people being reached and the amount of dollars being dispersed. But where maybe there is a little bit more controversy is on the question of whether or not that's a good thing. So on the one hand, proponents point to things like expanded access and the ability for credit to help consumers reach their goals or become more resilient, ultimately reduce poverty, as reasons why we should be excited about this transformation. But on the flip side, critics point to things like expensive products, consumers being misled, consumer abuses like exploitative debt collection practices, and this cycle of over-indebtedness that can occur when individuals are taking out too much debt. So with that, we wanted to put together this report that brings together evidence and data to help address these questions and better understand what's happening with the effects of digital credit, and to build a more shared understanding and vocabulary of how we can have these discussions. So today, what Seth and I are going to do is run through mobile instant credit in the broader digital credit ecosystem. And so we're going to define that term and put it into context for you. We're going to look at the welfare effects of what mobile instant credit. And that's really drawing on this rigorous body of evidence that's come out of our financial inclusion program, the Digital Credit Observatory, over the last 5+ years. And then Seth's going to take a look at misconduct associated with credit and the effectiveness of consumer protection tools, research that's really complementary coming out of Innovation for Poverty Action's Consumer Protection Research Initiative. And then finally, we'll summarize some key takeaways and think about how this can be used going forward and what the roadmap looks like. So to start with mobile instant credit in the digital credit ecosystem, let's first define these terms. So many of you might be familiar with CGAP's definition of digital credit as instant, automated, and remote. And we think that's a great definition. And mobile instant credit would in fact be considered a digital credit product. It's the first digital credit product. But Seth's going to talk in a minute about how the number of products has really expanded in the 7-8 years since CGAP put out this definition. And it's no longer really sufficient to have a shared understanding of what everyone means when we just say digital credit. So we wanted to introduce this term. We really encourage people to start to adopt it. And so the three features here are that these loans are mobile. They're dispersed and repaid through phones, whether it's a smartphone or a USSD feature phone. Often this is accompanied by machine learning algorithms and novel data sources that are used for the loan underwriting. They're also instant, dispersed very, very quickly, and often with terms as short as a few days up to a couple of months. And this is going to be important when we think about the effect of late fees and the penalty that borrowers pay for repaying early when we think about interest rates. And then finally, credit. So we're targeting individuals as consumers here. These are generally going to be small consumption-oriented loans, as opposed to loans for more productive use cases. And there's going to be a lot of kind of newer, similar products that we're going to differentiate this from. So for example, overdraft facilities that are really more of a revolving than a term type of loan, or buy now, pay later credit, which is similar to mobile instant credit, but the loans are tied to specific goods or services. One of the canonical cases here would be for solar panels. All right, so this is mobile instant credit. And now Seth is going to put this into a little bit more of context in the ecosystem.
Yeah, thanks a lot, Dan. So as Dan mentioned, there have been kind of waves of digitization of credit. And so much of the research that SIGA and IPA and other organizations have focused on has been on that first wave of what we are calling mobile instant credit, which traditionally people just refer to as digital credit. So products like airtime loans, but also specifically M-Shwari types of products for those that are familiar. And so here we kind of situate the landscape of mobile instant credit and airtime loans, which are highlighted in green, amidst the broader kind of portfolio of credit products that are increasingly proliferating in the ecosystem. On the next slide, we can see how this wide variety of products increasingly includes things like the second wave, what we think of as a second wave of digital credit, which would be things like buy now, pay later, the overdraft facilities, which are identified in red. And if we click to the next slide, we've started to think about how should we be organizing our minds around how these products, a kind of a taxonomy of these products. So on the y-axis, we've divided the products according to whether the providers are targeting individuals as consumers, kind of on the north, versus producers and entrepreneurs on the south, on the bottom of this page, right, in orange. And so airtime loans and mobile instant credit, which Dan is going to share evidence about in a few slides, is really going to be targeting individuals as consumers. And one of the kind of takeaways, or one of what were our kind of insights here, is that we really want to encourage development practitioners in particular, including many of you, hopefully, to start to think about the future opportunities for focusing digitization of credit on more productive opportunities as opposed to consumptive opportunities. Next slide. On the next slide, we'll also encourage people to think about the different ways that we can organize, the different dimensions along which we can organize these kind of different products, the diverse portfolio of products. So one key dimension is how secure the products are in terms of collateralization or lack thereof, with mobile instant credit and airtime loans being unsecured on the bottom, and on the top, some other more asset-based financing being much more secure with collateral. In the middle column here, we think flexibility of the loan use is an important dimension. So is this just cash that you can use for anything? Or is this kind of earmarked funds for just buying airtime, for example? And then on the right-hand side, we think that the dimension of the intensity of human interaction is really important. So is this algorithmic underwriting done remotely that requires very little human interaction, such as airtime loans and mobile instant credit? Or is this, the more traditional approach where you're borrowing from friends and family or informal lenders, which is kind of the most extreme counterfactual to the digitization of credit, right? The status quo in communities that don't have access to digital credit is to borrow from people close by or people they know well. Next slide. Of course, many in this community, maybe some in the audience, have kind of come up understanding and researching and developing products for microfinance. And so we recognize that digital credit is kind of an outgrowth of a tradition of trying to do development-oriented financial credit and microfinance. And so there's a lot that we can learn from the microfinance literature. There's more that we can also learn now from the digital credit literature and the mobile instant credit literature that Dan's going to share quickly. And what we'd encourage people to think about is to think of these as layers of learnings, which should inform how we orient ourselves to the future in terms of innovating products to have larger, more transformative development impacts than, frankly, we've seen in the mobile instant credit space or even in the microfinance space. So with that, I'll hand it back to you, Dan.
Thanks, Seth. And so as we now get ready to transition into examining the evidence on the impacts and on the risks, this is sort of the framework that we're using to think about that initial question we had as to whether or not these products are on net being helpful. Right? We know that there have been these technical and design innovations that have helped expand access by using new approaches and new data sources. And we know that as compared to a more analog world, these digital loans have more differentiated designs and repayment structures, which are meeting a broader array of needs. But we also know that just because there have been technical innovations, that doesn't necessarily imply benefit. We've also seen a rise in consumer harms. And although that's paired with some promising new approaches for market monitoring for consumer protection, they haven't yet been tested at scale or integrated into markets in a more meaningful way that can counterbalance these rising harms. And so what we're about to show is sort of on net, we see this modest upside on the welfare side for these loans, but a lot of risk that comes with it. And so Seth alluded to the second wave, these future waves of digital credit that are coming. And so part of the motivation here is, can we take what we've learned from wave one of digital credit and apply it in wave two and beyond to think about improved loan design that can enable more productive activities? Can these innovations in market monitoring and policy be implemented in a way that really protects consumers. And so as of now, that's really uncertain. And we think we make the argument that that's largely why the role of research is so important, is to help us understand these questions and to find the best solutions. So as we start to think about what are the welfare impacts of these products, I'm going to point us towards the synthesis of these 6 primary key studies on the effects of digital credit. And I'm going to fill out this table in a second, looking at whether these studies found positive, negative, or neutral effects for each of these key outcomes related to credit. And so thinking back to that opening motivation, whether we think these products are harmful or helpful, take a second to yourself to think about whether you think that this is going to be something that we see more positive or more negative effects. And so what we actually found here is a lot of gray, a lot of neutral effects coming out of these studies. And so this is, I think, a really good visual representation of kind of the overall key takeaway of this synthesis of evidence. Along a number of kind of real financial outcomes, things like consumption, assets, financial health, we're not seeing that these products are having transformatively beneficial effects, but we're also not seeing a broad rise in harm in these kind of causal studies. We also funded a number of studies looking at the interaction between credit and gender, and unfortunately, they came back not really finding much of an effect. So there's sort of competing theories as to why women may be beneficially, positioned to benefit from these products or to be harmed. And on net, what we're finding is kind of a neutral effect. Now, what we're going to do is we don't have time to go through all of these, but we're going to look at just 1 or 2 key examples of how we've collected this evidence and how it can be used. So before I do that, let's take some of these abstract concepts of like small consumer loans and maybe make it a little bit more concrete by looking at the characteristics of the products in these studies. The first 4 were mobile instant credit, and the bottom 2 were airtime loans. And really what we see broadly is pretty high take-up rates from the mid-30s all the way up to 85%. Fairly small loan sizes, in most cases from a few cents up to a few dollars. And fairly high default rates. For a lot of these products, 7 to 15 to 27% for a number of these products. And so these are all, I think, pretty representative of the mobile instant credit space, both in terms of the demand that we see for these products, but also some of the risks that we're seeing through high default rates. Now, as an example of what these studies have found with regard to resilience, we have 3 studies here from Kenya, Malawi, and Nigeria, all examining how access to mobile instant credit helped participants respond to different types of shocks, for example, like a negative unexpected health expense. And so in the first example, one of the flagship results from this study was that those who had access to M-Shwari were about 6% less likely to have to forego some sort of expense, things like meals or medical expenses, in order to pay for that shock. And so this translates to an increase in resilience, which is a positive effect. But on the flip side, studies in Malawi and Nigeria didn't really find any effect at all. And to kind of give a sense of why that might be the case, we can look at the median amount that study participants reported they would need to deal with a shock, which was $26 as compared to the median loan that they actually took, which was $2. And so we can definitely see a disconnect there between what these loans are designed for and the ability to improve resilience. Now, subjective well-being was one of the real highlights from the synthesis. We saw a number of studies that pointed towards increases in subjective well-being from access to these mobile instant credit loans. So customers in Malawi in this one study report 12% higher, more likely to report being satisfied with their financial well-being if they had access to loans. And study in Nigeria examined how both access to loan and the size of the loan affected consumers, and found that access to the loans led to a pretty sizable increase in their reported subjective well-being. And so what's really interesting about this is it runs in contrast to the fact that on real financial indicators, consumers actually were no better off on average, and yet their subjective well-being improved. So one mechanism that some authors speculated that needs further research is that because shocks are fairly common, you can have a lot of mental stress from trying to think about how you will deal with these shocks proactively. And knowing that you have access to credit can be helpful mentally in understanding how you can do that. So ending on sort of a positive note here as we think about the impacts of credit. But now I'm going to transition over to Seth to think about some of the risks on the flip side.
Thanks, Dan. So as Dan mentioned, focusing on really rigorous, in some cases, randomized, in other cases, kind of natural experiment types of research, the causal evidence doesn't suggest much downside. In contrast, when we look at a wide variety of, in particular, descriptive studies that look at kind of cross sections of digital consumers, we see unambiguous risks that we have to be honest about. And on the right-hand side of this slide, we kind of provide a little bit of a framework for how we think about consumer protection risks in finance. We think about high and hidden prices, debt stress, which is not an easy thing to identify, but something that we kind of intuitively know is important. Something we call post-contract exploitation, which is basically examples where the providers renege or don't provide services that they are committed to providing. So whether they're overcharging for withdrawals or they're not providing redress for complaints. Fraud and scams, which everybody is well familiar with, and of course, data security, privacy issues, and ultimately discrimination. So moving to the next slide, we're going to dive into just some quick data. We can't go through all of this. It could be the focus of a multi-hour presentation, but we'll just provide some high-level examples. On the left-hand side, we have evidence of high prices of what we're calling mobile instant credit, right? So some of the products that many of you are familiar with, these are often monthly fees which stack up to be incredibly high interest, particularly given that they're so short-term. On the bottom, we have a more specific example from a targeted randomized control trial in Malawi, where the cost of airtime was just exorbitantly high, over 1,000%, according to the authors of the study. And this is in comparison to already expensive credit in the communities, from the village and savings loan associations, which cost basically 200% in terms of APR, from money lenders where it would cost 500% APR. So just the point being that they're very expensive sources of credit. In the center here, we see that agent overcharging is a major problem. So IPA did some really wonderful mystery shopping in Uganda, Tanzania, and Bangladesh, and found that in Uganda, 19% of transactions were overcharged, and the vast majority of that was focused on cashing out. A big problem in Uganda, a slightly lesser problem in Bangladesh, with Tanzania kind of being in the middle. Also, surveys that IPA ran in Nigeria, digital finance consumers said that among their biggest concerns were overcharging by agents and unexpected or unclear fees. On the right-hand side, we give one example of fraud, which is from a study that looked at the metadata, using metadata to identify whether apps on Google Play Store were kind of fraudulent or predatory, and found upwards of 70% of digital lending apps on Google Play Store, a platform hosted by a major tech company with a large capacity and principle to screen such things. 70+% were either predatory or fraudulent. On the next page, we're going to share some very brief evidence on this idea of debt stress. Then on the left-hand side, we see that unambiguously kind of loans offered through mobile banking by banks or by fintechs, digital loans, had the highest level of default among those that were surveyed that were borrowers. And in particular, those who borrow multiple loans from multiple providers on the bottom left here are going to be the segment that is going to default the most and pay late the most frequently. And on the right-hand side, we see this rise in debt and indebtedness really has real-world implications, with female borrowers in particular reporting, 41% of them reporting that they reduced expenses on food to repay loans. And this leads to kind of a vicious cycle of indebtedness. Within 5 years of M-Shwari's launch, the first kind of mobile instant credit product being launched in Kenya, there are already almost 3 million borrowers who had defaulted on loans, who of course get reported to the credit bureaus, and start this vicious cycle. So that's some evidence on the potential harms, downsides, and what we call kind of like robust descriptive evidence suggesting risks. There are also some promising new approaches to both empower regulators to monitor markets broadly, and also directly to empower consumers. And we divide kind of consumer protection interventions in those two. So on the left-hand side, you see a list of potential interventions for regulators, everything from requesting transaction data, doing mystery shopping, high-frequency, low-cost phone surveys, a wide variety of interventions that IPA has really innovated with policy partners in places like Uganda, Nigeria, Tanzania, and elsewhere. On the right-hand side, we see interventions that can be directly targeted to consumers. And again, places where IPA's Consumer Protection Initiative has supported some rigorous studies evaluating some of these interventions, as well as SIGA's work. In particular, ideas like loan wait times and enabling flexibility in repaying loans, access to legal representation, and others as well. Next slide. So there's a wide variety of things that both regulators, as they monitor markets, should consider, and we put those on the bottom here, kind of cross-cutting market monitoring opportunities that are relevant to lots and lots of different consumer protection risks, ways to give regulators more visibility on what's going on so they can intervene. And then the individual targeted kind of interventions we organize by this kind of consumer protection framework that I introduced a few slides back, to give you an idea of different approaches, either thinking of the market as a whole or individual harms and misconduct in particular. Now, of course, we'd be remiss as a funder who supports research in the digital finance space and as someone who implements this funding and supports researchers not to pose some future questions for further research. And so in particular, going from the top left here to the bottom right, we encourage people to rethink how the design of mobile instant credit products should look. And further, if we think of that as the first wave where we have kind of underwhelming findings, how should we be redesigning these products? To the second question, looking at the welfare effects of the newer waves of digital instant credit, buy now, pay later, mobile money overdraft facilities, and all the other digital products that are proliferating really lack rigorous evaluation. So we very much need to know and get back up to speed on the newer waves of products. Furthermore, we encourage people to look at how can digitalization better enable productive credit uses. As we tried to motivate at the beginning, we do think the development community really has to focus on encouraging more productive uses, and it's not entirely clear how to do that effectively. How should we innovate credit data systems in the context of digitization? There are lots of exciting ideas around open banking, kind of next generation credit reference bureaus, new data sharing opportunities, places where we think things like privacy enhancing technology can be really impactful. And also, this is some of the work that SIGA has supported as well. How can we improve measurement and monitoring of the market, right? So both as researchers and as regulators, supervisors, what should we be measuring and how should we do so effectively in a cost-effective way? When we know face-to-face surveys can be expensive, there are also a bunch of different modalities for kind of triangulating to get an understanding of the market through various approaches, which we've described before. And then finally, how should we reform the regulation in general? Always a universal question, but in particular to improve redress. So as we gain visibility and measurement of complaints, what can we be doing to facilitating the redress of those complaints? I think that's a major open question and something that needs to be extended kind of the last mile to rural consumers, to lower literacy consumers, to consumers that may not have smartphones or otherwise have access to these traditional resources. Over to you, Dan.
Thanks, Seth. And so this is going to be our final slide. And so if there are any kind of questions, feel free to throw those in the chat before we wrap up here. But I'm going to just quickly recap some of the key takeaways from this report. The full report will be coming out in a few weeks, so this is just a teaser. But at a high level, what we found, first and foremost, limited impacts. So we saw some positive welfare impacts, but they've been modest. The most notable of them is increases in subjective well-being. And this comes despite these associations with debt stress and diminished financial health. None of these causal studies found negative average impacts. However, it's important to put those studies in context. We've still seen this really robust body of descriptive evidence that Seth mentioned that does point towards a diverse set of consumer protection challenges. And that includes things like debt stress, like overcharging, like predatory collections and fraud. That said, there is some reason for optimism. We've seen a couple of different pilots and causal studies that have confirmed some promising approaches to improve market monitoring and to empower consumers. And so the next step will be to really build on that evidence base and to scale up some of these solutions that seem to be working. Now, we mentioned that this first wave of credit, and particularly mobile instant credit, is a more consumer-oriented loan product. And so this evidence coming out of the synthesis is really, really informative for other consumer-oriented products like buy now, pay later, and overdraft facilities. We want to really direct attention to more research on newer forms of credit that are really intending to facilitate productive activities and where there really still is not enough research. And then finally, despite that, we do think that this evidence can be informative for the regulation and development of digital credit more broadly. We don't want to reinvent the wheel every single time there's new products. So the point here being, let's take this for what it is and use it to inform the next wave of credit policy and design. So for those who are researchers in the room, Seth's already kind of given you some of the things for the future. We've already talked about some of the open questions that we think are really important. But for those who are practitioners or for policymakers in the room, our hope here is that some of this evidence can be informative to you, and we're happy to engage in a conversation around how what we found can translate to the problems you're trying to solve. And then finally, this is a dynamic, fast-moving sector, and there's really a constant need for new evidence. We know that Seth's doing his part, so I thank him for helping fund some of the research that we're doing at SIGA. But there really is a need for more funding, and in particular, as we said here, pointing towards these productive economic functions. And then finally, if nothing else today, I hope you all take away this new term, mobile instant credit. Please go forth and use it. And we hope that what we've done today is to help create the frameworks for a better shared and more sophisticated understanding of what we're talking about with these very nuanced, differentiated products. So with that, please, sign up for the newsletter, reach out to us with any comments or concerns, and this way you'll get the full report when it's available. We do have a few questions here in the chat, so I will, let's maybe turn over to those. So the first one here, it was noted that the findings on gender are neutral from these studies. Can you share more about this? What exactly do neutral effects on gender mean in the context of this research in digital credit?
Yeah,
So
Dan, that's a great question. Yeah, I just wanted to respond to that one in particular. So what I think has been really nice about both SIGA's, the work that SIGA has funded and also the work that IPA has funded is it's really encouraged researchers who win the kind of grants through these initiatives to take gender very seriously as something that they should look at. And so many of these studies, in fact, I think probably all if not most of the studies, in their sampling included both men and women quite intentionally. So they after they had done the data collection and run the interventions, could actively kind of analyze the results for gender disaggregated results. And in doing so, the studies really failed to find different impacts for men and women, which might not be surprising in the sense that most of the studies, as Dan suggested, didn't find impacts overall. But for those who, believe strongly that women and men engage with digital products differently, that might actually be surprising. And so I think, Dan, correct me if I'm wrong, but that's, I think, how we have been thinking about kind of what we mean when we say they're kind of gender neutral, in the sense that the null effects apply both to men and to women in these studies.
yes, or, if the effects were positive, they were equally positive, or if they were negative, they were equally negative. Yes.
And I just wanted to also surface, there was a comment about, the value of differentiating between wave one and subsequent waves of digital credit. And I appreciate that comment because, we recognize that digital credit is not something that has happened and is a foregone conclusion. It's also not something that, it's not like there's an up or down vote on whether we should or shouldn't digitize credit. We recognize that markets are dynamic. Entrepreneurs are always trying to find their niche. They're going to use digitization of finance more broadly to drive innovation in these products. And so we really want to make sure that we're extracting insights from each wave of study and applying those to the future, recognizing that markets are dynamic places, and what was studied 5 years ago might not exactly look like what's in the marketplace now, but certainly has some relevant learnings and insights that could be applied, particularly for policy and development practitioners now in a much different market.
There were a few other comments pointing at the digital literacy and its effect, or on kind of the effects of how hard these providers are looking to kind of push these products. And so I want to acknowledge those are great points and good questions, but we are at time. And so I want to be respectful to the next presenters. And I want to thank the Center for Financial Inclusion and the hosts for this great event, for giving us the opportunity to share this with you all. I hope everyone enjoys the rest of their day and has a great financial inclusion week. And we look forward to hearing from you and to sharing the full report.
Happy Financial Inclusion Week. Thank you very much.